very much for including paper in the program. This is joint work with Xin He, who just graduated this year from City University of Hong Kong, Gavin Feng and Jing Yu He. Xin did most of the empirical work for the paper actually. So what we want to do in this study falls into the second category that I was talking about. Machine learning AI tools, how they can potentially help answering some questions rather than the problems or questions they bring in. So we are motivated by definitely a core asset pricing question, but as I'll show you later, the framework that we're trying to introduce, this class new tree-based models would be more flexible for many other problems where you have unbalanced panel data as well as some theory-guided requirements when training a particular model. But let's focus on the asset pricing application first. So we've seen a lot of factor models that used to explain asset returns, risk-return trade-off, average returns. The well-known ones, I don't have to repeat. They are all quite well-known. Where does machine learning come in? Well, perhaps we have too many factors. We have a big factor zoo. So dimension reduction, in order to deal with the high dimensionality of input features, in order to deal with the large number of factors, is important. And that's not something traditional econometric tools completely address. So that's where machine learning methods do come in. We have a lasso ridge, regression, elastic net, kind of principal component-based methods, IPCA, and also neural net models that help with capturing nonlinearity and high dimensionality, so on and so forth. Where our paper is trying to contribute is we're going to use another class of model, innovate from that another class of model, tree-based models, in order to come up with a class of models that's going to help with a asset pricing application, basically pricing the cross-section of assets. So we're not the first to do this. There have been applications of tree-based methods in asset pricing in finance. For example, Alberto has done work on relating predictors to the weights of portfolios. We want to build on that framework, but that have a number of innovations to this traditionally used tree-based models. That's going to suit the features of financial big data. What are the features? High dimensionality, I already mentioned, nonlinearity, interactions among different input features. And in financial market, we have really low signal to noise. And in a sense, tree-based models are even better than neural network-based models in dealing with low signal to noise environment and also short observation history. Happy to expand on that if that's of interest. And in many settings, we actually have really have a lot of information in the time series. Many of the time series econometric models we have, be it Riemann or Gauge or Arch, require some sort of stationarity assumption or meta-stationarity assumption. Many of the machine learning models are trying to not fully resolve that problem, but at least extract more information, letting data tell us how long a look-back window should be, which assets to focus on, which moments to focus on. So as hopefully I can convince you the model is going to accommodate these features of financial big data, but more importantly, the reason we want to use tree-based models as compared to deep learning models is that it's more transparent. We're not dealing with a black box with many layers of neurons, so on and so forth. We're looking at a decision tree. You see clearly which feature comes in, how, and when, and how do they interact to generate the leaf portfolios. And if you're a practitioner, you know clearly how to generate that portfolio as compared to using some other more complex models. And of course, there are trade-offs that we have to think about. So starting with the key question that we're trying to answer, right? If we think about any conditional SDF models, typically, we write down the no arbitrary condition, and the natural pricing kernel is written, we use M here to denote the SDF. In this form, it's going to be related to individual asset return characteristics, asset return patterns. We don't typically estimate this model just because the variance covariance matrix is too big, right? If we look at individual assets, we're using basis portfolios. And how are they typically generated? I would say they are generated in a way that's a little bit ad hoc, right? Sorting along certain characteristics, 10 of them, long short portfolio. So is there a more data-driven way, a more endogenous way of generating basis portfolios, and then go from there, use those basis portfolios to construct this pricing kernel. That's what we want to contribute. So why trees? Why not any other approach? There are a few advantages for using tree. One thing by construction, well, actually, the first one is just it captures nonlinear patterns really well. If the data generating process is linear, trees are going to do horribly relative to ORS. But in general, if there's nonlinearity interaction, it's going to do well. It does handle high-dimensional input features. So that advantage is there, not specific to our tree model. It's general for any regression tree or classification tree models. Second advantage, it's really useful for low signal to noise environment and a shorter observation window. For various reasons, there's averaging at the node level. There's averaging when we use random forest, basically superpositioning many tree models in order to average out certain noise, avoid overfitting. Also the fact that relative to neural net models, which doesn't have a concept of error term, right? Each layer of neuron, you might be propagating noise to the next layer, whereas for tree-based models, there is a split criteria that's typically some minimization of error-based. So there is some discipline to deal with it. That's why it's good for low signal to noise environment. And finally, we're generating leaf basis portfolios that could serve as tests and at the same time recovering the SDF by constructing a mean variance portfolio from the leaf portfolios. What are the typical tree models? For example, CART model, right? Classification regression trees that widely used in many disciplines. Well, typically in the nodes, what we assume is in the time series, the observations are IID. The variable is IID. So there's not an explicit time series extraction of information in typical tree-based models. And the typical split of the growth of tree is local and recursive. I'll be more specific on that, what we mean by that. And that's not designed to suit asset pricing application. What are the conditions that we typically require in asset pricing? Well, we might require no arbitrage. And that's not reflected in the typical growth of tree at all. So these are things that make traditional tree models not very suitable for asset pricing. And finally, if we worry about overfit, we typically use random forest, basically ensemble-based methods. It's true that it guards against overfitting, but what we lose there is once you have a few hundred different models put together, you no longer observe the tree branches. We actually don't know how features interact anymore, as compared to looking at a single tree. But a single tree's problem is it tends to overfit. So we hope to address that concern as well. So we're going to introduce a class of models that's called panel trees, or P trees for short. That's interpretable because we're using single trees, yet we're still guarding against overfitting. At the same time, because we are going to get rid of this assumption of IID, in the application of asset pricing, that will be, instead of putting returns, average returns in each node, that's average over time, we're going to put a vector, a time series of returns, which is going to allow us to do more in terms of figure out the interaction of macroeconomic variables with cross-sectional firm characteristics, so on and so forth. So hopefully that will become clear in a little bit. Just to go back to the baseline tree model, what are we doing? We're essentially partitioning observation. Let's say these are asset return observations in the space of their characteristics. Let's say book to market, sorted book to market. Here I'm just showing you two-dimensional example and market cap. So in the root node, before any split of the tree, what we are essentially doing is we're claiming, okay, if I want to have a price model for these returns, I'm basically using an average. I want to use a constant that approximates the returns of all the observations within this node. And then when I try to grow the tree, what we're trying to do is we're searching over possible splits along the size dimension so that I can introduce two constants to approximate the returns in each bin. Right? So this is very much related to sorting, but just more endogenous or more data-driven compared to ad hoc division of into 10 deciles. Okay, so that's doable. And the typical way to do it is we search over size. We might be searching over value. We can do sequential growth of the tree. Here, essentially, we're using 3 constants, try to price assets. If they fall into a particular bin, my estimate would be that should be the return. So this is recursive in the sense when I try to split at this node along value, I'm really just considering assets here. It's a local consideration in terms of split criteria. What exact split criteria do we look at? Typically, we're just trying to minimize pricing error. We're using a linear constant, not linear, we're using a constant to try to provide pricing for assets when they are grouped into the leaf nodes. Typical tree models basically don't have this time series dimension, but what we can instead do is we can use a more global criteria. Instead of minimizing this error just locally for this branch, we can introduce a no arbitrage condition that's true across all assets, across all branches, in order to add some discipline. Traditionally, that wasn't done in science and engineering because you use a local recursive approach, it runs faster. But the global search is not much more costly in terms of computation. We can easily do that these days. But what is essential for tree-based method is that compared to exhaustively enumerating all possible sequential sort, which is an NP-hard problem, that's not computationally feasible. Trees are essentially using a greedy search, right? Approximately, we explore all possible interactions and sequential shorts, but it's not a full search. That's why computationally it's feasible. So we preserve that feature. So how exactly do we do it? The criteria we're going to use is we're just trying to price all the assets using a pricing kernel, which is going to be linear in some factor that we're going to construct from the tree, right? And this is pricing assets in all the leaf nodes, right? All the assets in the data set. So it's a global criteria. How do we, the linear model is fine. We can estimate the coefficients, try to generate a linear model, but how do we come up with this factor? Well, the factor is actually going to be generated from the leaf nodes in this tree. And I'm going to show you some pictures. But in order to estimate beta, the loading on the factor, we do make use of the fact that the observations we have in each node is a time series. We need to run a regression there to estimate the loading. And that's something we typically do conventional tree-based methods because there's no time series dimension in those entries. So once we do that, we can generate this factor based on a global criteria. So this is the global criteria. So how exactly is this done? This is the root node. Suppose I'm searching over all dimensions, and it turns out that the volatility of dollar volume matters a lot. And just for simplicity, I'm cutting the grids into five parts, right? Quintile. Just for simplicity, you can make it finer. That's fine. If it falls into the bottom 20 percentile, it's going to go to this left branch. Otherwise, it goes to the one here. Just indicates it's split once, right? We have 2 leaf nodes. How do we construct the factor? Well, we can simply do a mean variance optimization of the leaf portfolios in order to generate this single factor for pricing assets. And after that, we can plug it into this conditional linear factor model to see if it prices the individual assets well. And the objective that we're trying to minimize is really the pricing error, right? Globally, across all the cross-section of assets. And that's going to allow me to figure out which variable and what is the cut point to split the variable that's going to give me the minimum error, at least for this step, just for the first split. I can do that, right? Once I do that, I can repeat the process. Now I search all other candidate variables and potential cut points for my second split. And after the second split, after a candidate split, I have 3 leaf portfolios. Again, I do a mean variance optimization to get the factor, again, a single factor model, try to price the entire cross section and see which feature and which cut point is going to minimize the pricing error. And we can do this recursively in order to get to a full-grown tree in this particular setting. Okay, that's for a single factor, right? Once I grow this tree, I need to stop somewhere. So the stopping criteria we use is whenever the tree reaches F6, or whenever the portfolios, each leaf portfolio has assets less than 50, I'm going to stop the growth of the tree. Are these the optimum numbers? Probably not. These are arbitrary numbers that we pick. But you got to pick some number. We don't want the nodes to contain too few assets, right? Otherwise, the individual asset noise is going to play too big a role. But one thing we can do to generate multiple factor is we can, regress on the single factor, and then pass the residuals through another P tree to generate the second factor, right? The idea of boosting the tree applies here. So we can generate however number of factors that we want. In the empirical exercise, we generate 5 factors, for example. That's all P tree based. So let's look at the empirical performance. So we apply this to both US equity data and corporate bond data. I'm going to focus on the results in equity data. I don't think I have time to talk about corporate bond, but that's something we have the results. Not quite in the paper, to be fair to our discussant. So 40 years of data divided into 2 halves. One is for training, the other is for testing. We're not recommending a selection of the models. We don't need a separate validation set, right? We're just trying to figure out all the sample performance. 61 characteristics, definitely very high dimensional input feature. In a few categories, they are the usual suspects, right? Book to market, momentum metrics, profitability measures. This is the tree that's endogenously grown. So essentially, the first split is along volatility of dollar volume. Second split indicated by S2 is market equity, industry adjusted. What do we mean by industry adjusted? Well, for all these variables, we standardize them in the cross section between -1 to 1. So when I say industry adjusted market equity, I'm just standardizing or scaling whatever number we get within that industry. Okay, fine. So these 3 tend to be the first 3 splits that would give me the best pricing performance, at least in sample. We can measure this pricing performance more carefully by looking at total R square, predictive R square, or if we're talking about portfolio test portfolios, cross-sectional R square. These are the usual metrics people use. And P-tree 1 means one factor model. P-tree 5 is 5-factor model using boosted P-trees. MA P-tree means market adjusted P-tree model. Basically, you can run the asset returns on the market factor and pass the residuals through a P-tree to generate the second factor. Okay, so this is their in-sample, out-of-sample R square for individual stocks and portfolios. Safe to say P-tree models, especially P-tree 5 and market-adjusted P-tree 5 are among the best performing models. There are some serious competition from IPCA, for example. But here is where interpretability matters. If I'm using principal component, I really don't know what is included in my principal component. I mean, there's hundreds of them. But in a P-tree, you see clearly how you interact the characteristics to get to the leaf portfolio. And plus, IPCA doesn't price test portfolios very well. In addition, the leaf portfolios, remember, they could be used as test portfolios at the same time, in addition to constructing this SDF. So if we look at the P-tree 23 portfolio in P-tree 5 and the market-adjusted P-tree 18 test portfolio, they cannot be explained or spanned by other factor models, but they could be by the P-tree models. So in a sense, it's the P-tree model could be spanning the efficient frontier a bit more. Now, if you look at portfolios constructed from the P-tree models, how do we construct portfolio? Remember, we generate the leaf portfolios, right? We can do an equal weights of the leaves. We can do a mean variance optimized portfolio of the leaf portfolios, and just look at their average return, annualized swap ratio, and monthly alpha. The P3-5 and the market-adjusted P3-5 models perform quite well, both in sample or out sample, relative to other factor models such as risk premium PCA or Hoshi-Zhang 4-factor from a French 5-factor models. There are also certain, we call it interaction factors. You can view this as portfolios created through interactions, interacting the characteristics, or portfolios created through sequential sorting. They are not quite spanned by traditional factor models. So in a sense, you can view them as anomalies. But of course, once you put it into the P3 framework, it can be explained better. One important application of P3 or versatility is that you can introduce time series split. That's what traditional tree models wouldn't cover. So, but still, we observe 40 years of data. If we're focusing on interacting multiple time series variables, the observation is still small, right? So the exercise we did is we allow the first split to be along some macroeconomic variables, such as inflation. Then after that is the usual cross-sectional firm characteristic that we use to keep growing the tree. And if we train this model, it turns out that inflation is the key kind of regime or macroeconomic variable that's going to help explain the cross-section when interacted with firm level characteristics such as the price reversal or market equity with industry adjustment. You could imagine doing this for multiple macroeconomic or time series variables. In our paper, we didn't introduce more interactions just because of the time series observation, which is short, right? Relative to a cross-section where you observe hundreds of thousands of assets. Another interesting implication of this is from the P3, you can clearly see how to interact with other characteristics in order to enhance the performance of certain anomalies, or even resurrect certain anomalies that are thought to have been treated away. Right? Now you know the right interaction to resurrect them. So that would be useful for fund managers or practitioners. And we also apply this to corporate bonds. And the data source is the standard data source, trace data, transaction level. All the characteristics are similarly lagged 1 month. And everything is standardized into -1 to 1. And there are 40 characteristics, roughly in 4 categories. Some are related to interest rate or maturity. Others are more about liquidity. This is the tree grown for corporate bonds. It turns out that the important characteristics to split along would be time to maturity, turnover, and I think there's also a standard Amihu's liquidity measure. There's some Rose liquidity variance that would be important as well if we go further down the tree. So in terms of asset pricing performance, for both individual bonds and portfolios of bonds, the benchmark would be, CAPM, Bailey and Wen and IPCA factor models. P3s and market-adjusted P3s would perform quite well. We are not claiming it's the best performing. Compared to IPCA, it's typically performing slightly weaker. But then it's the combination of good performance, asset pricing performance, interpretability, and understanding how different input variables interact. That's that give us key advantage of P3 models. So with that, I'm going to conclude here. I do want to add a remark that beyond asset pricing, which seems to be a perfect application of this framework, if you have unbalanced panel data and you have some theory-guided requirements or conditions that you want to impose while training the model, the P3 framework will be quite suitable for that. It's really a top-down solution to security sorting that's more data-driven, and you can use firm characteristics to generate both the basis test portfolios and recover a pricing kernel at the same time. So just tying it back to the key features or defining features of financial big data, high dimensionality, nonlinearity, these are definitely captured. Low signal to noise. Ability to address this is inherited from trees, but because we are not using ensembles, the p-trees are really more interpretable, and it's more versatile. You can interact with time series with cross-sectional characteristics. And the coding is posted on GitHub, so it's a public source. So I hope you all have a chance to explore with it. Thank you.
Well, thank you very much for inviting me to discuss this paper. It was an absolute pleasure to read it. And so let me just get started. Will did an amazing job, I think, at describing the main features of the paper. So I'm going to be very quick for when it comes to the summary of it. What the authors do, they propose a tree method for panel data. The key features are that they're going to be using global rather than local criteria, and the building of the tree is going to be done by following asset pricing considerations. It means that the main results, panel trees are going to be able to capture nonlinearities and interaction between stock characteristics. And when you go and make it compete against standard factor models or PCA latent factor models, it actually performs quite much better. Now, let me take a step back and show you, I think Will did it a little bit, but let me take a step back and tell you what a traditional regression tree is, so you can see exactly the difference between what the authors are doing and what people have been doing so far in the literature. Now, the way we usually you can think about what a regression tree by just looking at the way you look at the fit of a regression tree. If you have a number of predictor x's, and this can be 1, 2, as many predictor you want, what we're doing is we're defining the space spanned by these predictors, and we're creating disjoint regions, and then we're modeling the dependent variable as a constant in each region. Now, let me see. I think this is not working. Okay. Okay. Now, when I show this slide, many times people don't really understand exactly what I'm talking about. So let me just go and look at an example. This is what we're going to be doing is, once again, we have a y variable that we want to explain. We have an x1 and we have an x2. All we're doing is, at the end, we want to take the space spanned by x1 and x2. We want to divide it into regions. And then how are we going to be doing it? We're going to do it by just partitioning using lines that are parallel to the coordinate axis. And we're going to do recursive binary partitioning. So effectively, what a card algorithm will do is it will go through all the x1 potential splitting points and x2 splitting points, and it's going to decide which splitting point, when I then associate it with a constant on the right and a constant to the left, is going to diminish the most the empirical error that the model currently has. So in this case, it's going to be T1. So I'm going to have a split at T1, and then I'm going to have a constant to the left of T1 and a constant to the right of T1. Then what the algorithm will do, we'll go and do the second iterations. And in this case, actually, it splits along T2. So you're going to have now a region here and a region here. And you can imagine that I can keep on doing it. And the way I do it is exactly in this recursive binary partition way. Now, one thing that you'll notice, of course, this is a very hierarchical procedure, right? The first split is going to determine whatever comes afterwards. And another thing that is very problematic is I'm going to be using less and less data in each region. And so I'm going to be more and more prone to overfitting. In the end, if I keep on going, I'm just going to isolate every single data point I have in the data. Of course, if I have 2 variables, it's not a big issue. But if I start having 4, 5, 6, 10 variables, then I'm going to be basically getting into the curse of dimensionality very, very quickly. So what people traditionally have done is using boosting. What boosting does is you fit a tree, and then you're going to be obtaining the residuals, and then you're going to keep on fitting additional trees on the current residuals of the model. And in order to shield against overfitting, what people will do is having a subsampling and a shrinkage step into it, exactly to shield towards getting some outliers in the data and basically imposing some sort of regularization. Now, what the authors are doing here is very interesting because it's very different. The authors are going to be working with a single decision tree. They're going to be working with a tree that can work in panel setting. In most of the cases, regression trees have been either work in the cross-section or in a time series dimension. And in particular, this is also driven by asset pricing considerations. So the way this tree is going to be built is not going to be done by kind of minimizing the sum of square procedures in fitting the data, but it's going to be done in fitting an asset pricing model, which is, I think, is what is very exciting. Now, these are very hard features to embed, but they're also very desirable. And I think also what I want to emphasize is that this is not an off-the-shelf implementation of other algorithms that have been developed. This is like brand new. Now, why do I say that it's driven by asset pricing consideration? You can see it over here. The trees, the splitting points are going to be all defined by kind of fitting a factor model. So jointly, you're going to define what the portfolios are and the splitting point in at the same time. And this is very different, for example, what has been done by Brigalova and Perger. They create a candidate set of portfolios, and then they just exclude some of them. Basically, they do some sort of lasso regularization. This is very different. Like, I'm going to endogenously build the portfolios that should belong into my asset pricing model. Now, so this is why I think this is extremely exciting from a point of view of advancing. Now, I'm going to have a number of suggestions, and this is, I'm basically just raising the bar for the author because exactly because they're offering something that is new, we have to be very careful about how we approach this. Now, as Will was saying, the authors approach this problem by imposing or choosing a set of hyperparameters, right? So they're going to choose what is the maximum depth of the tree, how many observations you have in each leaf node, what is the kind of shrinkage parameters to be used in a mean and covariance estimations, what is the number of factors when they actually do boosting. The problem is that in some cases, this choice of hyperparameters is very innocuous. Like if I go in the statistical learning literature and I see what is the performance of booster regression trees with different size, with different depth, like a stump is just a tree that has one node. And if you compare it with the performance of a tree that have a 10 node, 100 node, you can see that, I mean, you may have out of sample, as I increase the number of booster iterations, some differential performance, but roughly speaking, they all work. In some instances, instead, what happens is that some choices of the hyperparameters are going to be such that if you choose the wrong one, you're going to get into big trouble very quickly, right? So if I don't impose shrinkage in boosting, in some cases, you're going to have that as I increase the number of boosting iterations, I'm not going to have that the performance is going to level off, but I'm going to have huge divergence. So what I recommend the authors is to show some robustness with respect to the choice, right? If you're not willing to cross-validate some of this hyperparameters choice because it can be complicated, I think that the best way is to kind of show that the performance, roughly speaking, is going to be comparable across different choices. And I think that I don't have any problem with having that some hyperparameter combinations does not work. I mean, this is something that we all learn from this, in particular because this is something extremely new. And I think that this is kind of, with the second suggestions, is kind of related to this. Like when it comes to reporting the results, let's be more comprehensive, right? So instead of having a 1 or 5 factor booster tree, let's show all of them, and let's see if we have that the prediction or the performance kind of levels off, or it's a little bit unstable. I think that is something that can be equally interesting for the reader. Now, the first suggestion I have is that one super cool aspect of CART is the efficient coding. So this, what this allows CART to do is to by exhaustive search through all the possible splitting points and effectively capturing highly nonlinear features of the data. But of course, this comes with a cost. CART are extremely unstable. So if I show you the tree that I can build with a CART, and then I take out through 2 or 3 observations, the tree may look completely different. Now, what the author is doing here is they're limiting the kind of, instead of having all the possible splitting points, they're going to be focusing on quintile breaks. And if the issue is computation, I think that is not a big issue, a big problem. But if you instead start having that the performance deteriorates, if you allow for more flexibility, then you have to start thinking that these quintile breaks are nothing else but another layer of regularization that the authors are imposing onto their fitting algorithm. In terms of the fourth suggestion, I think that something that is super interesting is the time series splits. Like I've always been a big fan of market switching models, where you basically have that different economic conditions can be related very differently. They can be associated with very different relations between dependent and variables and predictors. And so intuitively super appealing. Right now, though, the authors, they're limiting themselves to one split at the root. And of course, I would be much, much happier to see something like interactions between time series and cross-sectional splits. And maybe given that it is true that some macro variables are available or only at a lower frequency, some macro variables are actually available at a higher frequency. So you can actually increase dramatically the time series dimensions in your data. And in terms of the fifth suggestion, I think that there is something very interesting about these interaction factors, right? Everybody's always thought about doing single source, double source, but you can actually go much deeper. But right now, the paper is a little bit limiting in the sense that there are a couple of examples, mainly in table 6, where you can see that this kind of interaction factor and conditional factors can dramatically improve the performance of some anomalies that have disappeared over time. But there is really not a unifying theme. So I can think that the authors maybe can take that part out and maybe write a full-blown paper only on this. But as it stands right now, it's just interesting for the reader, but it's just not complete. And I think also, once again, I think it would be nice to see what instead are kind of those anomalies that through the interaction factors, actually, they just get killed rather than kind of emerging. And finally, I think that, and this is kind of mainly exposition, and I think it's similar to also what the presentation that we'll have. I think there is, the paper is very loaded at the beginning, right? So you go through all the kind of the presentation of what the framework is, then you talk about regime switching, you talk about boosted trees, and then only after doing the entire theory section, you get some data. And I think that the reader will be much more excited to start seeing maybe some of the baseline results first, and then once they get a gist of how the data looks like, they're going to be much in a better position to understand what the regime switching and the boosted tree version of your P trees look like. And also, as I was mentioning before, I think it makes sense to kind of really expand the empirical results, because I think right now it reads a little bit too much like a method paper rather than like a full-blown finance paper. So let me just take a moment to conclude. I think that this is a fantastic paper, super interesting. Once again, I think what I find very exciting is that this is just not an off-the-shelf implementation of something that has been done in another field. This is a completely new framework that the authors are introducing. It's super creative and innovative, and I think that everybody that is interested in machine learning and the cross-return stock returns should read it, because they're going to learn a lot from it. Thank you so much.